Behavioral biases are preconceived notions or prejudices that often lead investors to make emotional and irrational decisions when it comes to investing. Let us understand how behavioral biases can get in the way of sound financial decisions. Meet Arjun, who is 35 years old and wants to make smart investment decisions. He is a strong supporter of the equity market and decides to invest some money in equity mutual funds. He scans through a few newspapers to find out the most popular equity funds in the market and invests in one of them. This is attention bias. In this bias, investors tend to invest in financial products which are frequently highlighted, say in newspapers, news channels, without analyzing their suitability any further. The next day, Arjun meets his colleagues Naveen and Vinita over a coffee break. They start discussing on various investment options to build a retirement corpus. Naveen puts forward his belief of investing in safer avenues like debt funds and fixed deposits. Arjun, however, emphasizes on the potential of superior returns of the equity market. Vinita, being a strong supporter of safer investments herself, ignores Arjun's opinions and focuses only on what Naveen says. Here, Vinita exhibits confirmation bias. In this bias, investors tend to seek out only those information or opinions that support their preconceived notions about investments. They tend to turn a blind eye towards information that does not support their opinions. Undeterred by the conversation, Arjun decides to invest some money in another equity fund. He does a quick scan of the last quarter returns for the mid-cap equity funds and invests in a fund which has performed spectacularly in the last quarter. Here comes our next bias, recency bias. In this bias, investors tend to invest in instruments which have only performed well in the recent past, without considering their long-term performances or other factors. Naveen, unlike Arjun and Vinita, is in his 40s. He is confident in his ability to build a substantial retirement corpus, even if he starts investing when he's closer to his retirement. He is very optimistic that he would be able to build an adequate corpus to lead a comfortable retirement life. Now, this can be construed as optimism bias. In this bias, investors tend to be overtly positive about their finances, with or without substantial actions or information to support the outlook. The next day, Arjun, Vinita and Naveen go to an office party. During the party, Arjun gets to know about a stock in which many of his colleagues had invested and who were of the opinion that the stock has a huge growth potential. Arjun, not wanting to miss out on a good opportunity, goes home and invests in the stock. This is herd mentality. In situations like these, investors tend to follow market trends blindly. They invest owing to the fear of being left out, without checking the relevance of these investments with their financial goals. Now, Naveen, who was also at the party, was having a discussion about the performance of a stock. He had invested in the stock around 5 years ago, but the stock had not been performing well for the last 3 years. Also, during his discussion, the fact that the future outlook of the company may not be very promising came out strongly. Yet, Naveen was not comfortable redeeming his investment, as he hoped that the company would recover soon. Here, Naveen exhibits loss aversion. In this bias, investors tend to hold on to unprofitable investments or invest in instruments having low return potential, just to avoid realizing a loss. So how do we as investors keep these behavioral biases from undermining our investment decisions? By following 3 steps. Recognize and acknowledge that these biases exist. Understand how these biases can affect our decision-making process while investing. Understand whether our investment decisions are done objectively. That is, they are based on factual data and not emotional responses. Adopt strategies to make investment decisions free from bias. For example, plan asset allocation before investing. Review and rebalance portfolios periodically. Take help from professional advisors, and so on. eliminate subjectivity, and make investment decisions emotion-free. Happy investing!